All right, good morning, everyone. We still got some people coming, but we're going to fire it up without them. So thank you all for coming. First up, we have Dr. Christoper Thornberg, who runs a company called Beacon Economics. He speaks all over the place. He introduced me to the term miserableism, which has been going on now for 15 years or so. But anyway, he's going to give us a look into the crystal ball to see what we're in for in the coming year with the new administration and so forth. So give a hand to Christoper Thornberg.
Good morning, everyone. Microphone on here. Can you hear me? Testing. One. There we go. Can you hear me okay? Excellent. So I gather we've got to know each other with the California Mortgage Association over the years. I've done a regular talk for them. So I am an economist. Did my PhD at UCLA back in the day. Is there a remote control? There it is. And started a company called Beacon Economics in 2006. And I want to give you a little background for what Beacon's about. Tell you a little bit about our philosophy, because I think what you're going to find today is it's not going to be a standard economic talk. I mean, we're going to dive into what's going on in real estate and interest rates and Federal Reserve policy. We'll be talking about the new administration and whatnot and what forth. But I want to go all the way back in time 20 years ago when I was at UCLA. I was working in the UCLA forecast where I ended up after getting my PhD there. And it was a very frustrating time for me because I remember looking inside UCLA and seeing all these really smart people studying topics that really had no practical implication for any real human being on the planet. And then I would turn around and look at the real world, and I would see people having conversations about the economy that were completely uninformed and in many cases ridiculous. And I thought, well, you know what I'm going to do here is I'm going to leave here. I'm going to go out there. I'm going to start my own company and try to bring a little bit of this academic integrity to the conversations about what's happening in our economy. And that was my mission, and I think we've done a good job. I got 15 people. We do all sorts of policy studies and impact studies and all that kind of new stuff. And I'm doing many of these talks every year. But with that said, what's been interesting is over that 20 years, my mission has not become easier. My mission has become harder. And I've started to have to take a step back and recognize that having a few numbers and having a few models is not how you understand the world. And to be clear, let me tell you what I'm going to talk about today, because there's really two things I'm going to talk about, and they are distinctly different. The first thing I want to talk about is what we think is happening in our economy, what you might want to call our lived experience or our social narrative, as the case may be. Then I'm going to turn around and I'm going to talk about what's actually happening in the economy. That is to say, our objective statistical reality. Now, when I did my PhD program, I was taught by the intelligentsia at the economics department at UCLA that these were the same things. We called it the rational agent model. You get into the real world and you realize that rational is not a good term for the vast majority of humanity. Ergo, we have to take a step back and maybe think a little bit more holistically about what's going on here. Let me back up so people can see. And the idea here, very simple, is to be a good forecaster, to see what's coming down the path. You have to pay attention to both. You got to think about the reality of things, and you have to think about the narratives. Because ultimately, it's narratives that drive choices. It's narratives that drive the choices of consumers, drive the choices of business people, drive the choices of policymakers from Washington, D.C. to Sacramento, to Santa Ana City Hall. But it is economic reality that will determine the outcome of those choices. And so really you have to think about both these things, and you have to acknowledge that they are indeed different. Although why they're different, well, I'm going to come back to that in just a couple minutes. The idea here very simply is that good choices and smart policy start with the correct narrative. And if you really want to know what's wrong with our world, is there's way too many false narratives cooking around out there. And they're creating havoc in a lot of different corners of the economy. In fact, in many ways, the disengagement of the narrative from reality is probably our greatest risk of all. Now, with all that said, look, I got a lot of slides here. I want to talk about housing, I want to talk about GDP, I want to talk about politics. I got a lot to go through. Don't want to take too much of my time allotted today. At the end of this, by the way, if you want to get a copy of these slides, I'll have time to do a little bit of Q&A. There'll be a QR code up. Have your phone out, get a picture of the QR code. You can get some slides, so don't worry about that. Don't worry about not falling behind on the data. You can catch up at some point in time. And like I said, at the end of this, hopefully we'll have a good 10 minutes or so to have a little bit of back and forth. And you can give me some of your thoughts on what you think's happening, all right? So, diving right in. Recent macro narratives. It has certainly been an interesting few years. Go back to 2020, of course. Obviously, the pandemic hit the U.S. economy, a tragic human period. And of course, as we all know, it was going to cause a depression. Well, that's what they told us. 10 years of depression and debt, worst downturn since the Great Depression. It's just going to be a complete wipeout. Mark Zandi was running around telling everybody that a third of all homeowners were going to be defaulting on their loans. Of course, none of that happened. But in 2021, we just simply morphed the narrative to how we were never going to recover. Oh, sure, it wasn't a depression, but we're never going to recover again, even as the economy was rocketing back to normal. In 2022, it was all about inflation and the interest rate spikes. And yet again, Zandi's telling us that 1/3 of homeowners are going to stop paying their mortgages and home prices were going to plummet. And of course, all that increase in interest rates and inflation in 2022 caused that 2023 recession. Everyone remember that 2020? Oh yeah, that didn't happen either, did it, right? So here we have, year after year, these calamities in the press. Nothing happened. The economy kept going forward. And then you get into 2024, and suddenly we're the envy of the world. We're the one developing economy that's moving forward. Our stock markets are going to all-time high levels. It's amazing how the narrative's shifted. The economy hasn't. The economy just keeps trucking forward in the same old way. But, of course, all this chaos in the headlines reminds me of one of my favorite economists, a man, John Kenneth Galbraith, who many years ago made a career out of himself, mainly poking holes in the hubris of other economists. Well, I remember that he famously said that the only function of economic forecasting is to make astrology look respectable. Now, I got to tell you, there was a point in my life where I was hurt by this comment. Right about now, I understand exactly where the guy's coming from, right? Now, of course, there was another big narrative in 2024. You remember, the election. Way too close to call. Nose to nose. No one's going to actually know who's going to capture the White House. Models all over the place. Nate Silver was telling us that it's a coin toss. And then, of course, November came, and it wasn't close. It was a total wipeout. Republicans took the House, they took the Senate, they kept the House, or maybe the other way around, I don't forget, whatever. They're running everything at this point in time. And, of course, even here in California, notoriously left-wing California, went right. Just look at the propositions that went down. We voted down minimum wage. I never thought there was a chance in hell that California would vote down that minimum wage, and we did. So everybody went right. And of course, that leads me to my new expression, which is the only function of election polling is to make economic forecasting look respectable, which, it's okay to punch down once in a while. Now look, we do forecast at Beacon. I contribute to the Wall Street Journal survey of forecasters. One of the questions they ask us is, what's the chance of a recession in the next 12 months? You see that line on the bottom? That's us. We were the optimists in the room over the last 3 years. We kept saying, no, it's fine. No, it's fine. Really, nothing's going wrong here. And, honestly, the economy continues to be fine. The one thing I can tell you, almost absolutely positively for sure, is the U.S. economy will continue to grow for at least the next year and probably the next two. Economic momentum is a powerful force. We came out of 24 and 25 with a lot of momentum. And most important, if you look down at the core numbers, here's the most important thing. Household finances, from any objective statistical measure, look fantastic. Wealth levels at an all-time high levels. Income levels at an all-time high level. American households look really solid on paper. That means they will continue to spend, and if they spend, the rest of the economy gets pulled along. That's just how it works. Consumers are 70% of GDP. They are the 800-pound gorilla in the economic room. Bingo. Now, with all that said, I'm still worried. In fact, I'm getting more worried. But the reason I'm worried is, what I'm worried about is not the short-run economy. The short-run economy will continue to grow because household finances look great. The reason I'm worried is why household finances look so great. because household finances look good for two very specific reasons. One reason is, well, we're not having to pay for all these wonderful government services we're getting on a month-to-month basis. Federal government is borrowing a preposterous amount of money on an annual basis right now. The deficit is 7% of GDP. We have 120% debt to GDP. We have enormous obligations for Social Security and Medicare coming down the pike. Clearly, this is not sustainable. And Americans feel like they're saving enough only because they're not acknowledging all the debt the government is building up on their behalf. The other problem here, very simple, is the other thing that makes balance sheets look so good. Well, my net worth is through the roof. My home price is up. My stock portfolio looks great. My crypto portfolio is looking great. I'm rich. You got to take a step back. You look at some of these asset numbers. I'm sorry, they don't make any sense. We have the second highest PE ratio in the history of the stock market. That's not sustainable. So people think they're wealthy, they think they're doing well, but that's because they're not paying the taxes they should be taxing, and they're not worth what they think they're worth. So ultimately, all this wonderful consumer-driven economy is on very, very thin ice. Simple as that. Now, of course, you throw in the new administration. Trump's in town, and wow, I knew he was going to test the guardrails, but man, is he really tested the guardrails, right? This guy is throwing flashbang bombs in every direction on a minute-by-minute basis. Economists are running around with their hair on fire trying to keep up. Everything he says, I got to go model, which is preposterous. This is the same guy who made, 30,000 misstatements in his first administration. Whatever you think of Trump, I think we can all acknowledge that the vast majority of the things that come out of his mouth, he doesn't even believe it. That's just who he is, okay? Like it or not, that is who he is. And the idea of running around chasing every little thing he says and trying to turn it into a news story, well, it's a fool's game. And it's just distracting, and it doesn't get you to where you need to be. Here's the reality. I'm not worried about what this administration is going to do. I don't think he's going to be a dictator for life. I don't think he's going to fundamentally change the federal government. Why? Because we have a system that is designed to only allow large changes when there is consensus among the majority of Americans. Guess what? There is no consensus among the majority of Americans. Ergo, it's going to be really hard for him to get anything accomplished. That was true, by the way, under Biden, and under Trump 1, and under Obama, and under Bush. In fact, the last time you can go back and see any kind of consensus in the United States is probably under the Clinton administration. And even that got a little ugly at times. So I don't see a lot changing from a political standpoint, but there's the problem. What you should really worry about with this administration is not what they're going to do, but what they're not going to do. Because what they're not going to do is deal with the deficit. What they're not going to do is deal with the bubble. Ergo, these unsustainable trends will continue to expand, and that means the potential pothole out there when reality reinserts itself into the federal deficit, into the asset markets, well, that pothole looks that much uglier. So in other words, if I had to sum it all up, the short term looks great, but that medium term, there's growing risk. What everybody has to be thinking about is when does that crisis start to hit? Again, not for the next 24 months. Could be 4 years. Could be 6. Best part of my job, you got to ask me back every single year to figure it out. Now, with all that said, let's jump in. Again, I want to get some Q&A, a lot to talk about, so buckle up. GDP growth continues to grow very, very strongly, about 2.8% over the course of 2024. 2023 was 2.9%. 2022 was 2.5%. Good, solid growth considering the limitations, of course, of our labor force. Big driving force has been consumer spending, and consumers just aren't surviving this economy. Consumers are partying like rock stars, okay? Foreign travel, an all-time high level. Restaurant sales, 50% above where they were pre-pandemic. Las Vegas has never been busier. Every single concert Live Nation puts on sells out. People are having fun. It's as simple as that. Yes, there's been a little increase in credit card delinquencies. The big question is it an anomaly or is it the tip of the iceberg? It's an anomaly. Look at everything else. HELOCs and mortgages and how low those delinquency rates are. The highest level of household distress is bankruptcies and foreclosures. And by the way, those are at record low levels. They've drifted up just a little bit from being functionally zero back in 2021, and now they're half of what they were prior to the pandemic when they were record low levels. So yeah, households look pretty darn good at the top level. Labor market softened up a bit over the course of the last year, but only really from being excessively overheated back in 2021 to what you might want to kind of call it a more normal equilibrium. There's certainly been no increase in unemployment, use of unemployment insurance, no increase in layoffs. The numbers are great. Real incomes continue to rise. Yes, real incomes, inflation-adjusted incomes are rising, and I appreciate that every single paper continues to say out loud the complete falsity that somehow or other prices are growing faster than incomes. Hasn't been true for a long time. Now what's interesting is not only are incomes rising faster than prices, but that's more so true for people at the bottom end of the earning scale than the top end. Over the last decade, people in the bottom 50% of earners have seen a 17% increase in their real hourly wage, at the top end about 11%. So yeah, over the last decade, income inequality has actually been falling. Has anyone seen that story in the New York Times? Anyone? Anyone? I didn't think so. It's amazing how many of the truths in our data never show up in newspapers, but again, that's the world we live in. And the outlook still is good. Real disposable income continues to grow. Our household net worth at an all-time high level at this point in time, $46 trillion above where we were just a few years ago. Amazing numbers overall. And consumer debt levels are actually relatively low. Household debt to income peaked, roughly 2006. And since then, we've been on almost a 20-year decline. Right now, household debt to income ratios are about 82%, which again, is lower than it was back in 2002 or 2001. This is not a nation struggling with consumer debt. It's just not. How about our fair state of California? Wow, a lot of interesting narratives about California. Of course, during the run-up to this election, anytime the right wanted to discuss anything and everything that's wrong with the left, of course, California became that prime example of an economy just shattered by socialist policies. And don't get me wrong, I'm not a big fan of our government in Sacramento right now. But with that said, I think our state may be taking a little bit too much abuse in the press as it might be. Now, a couple of things. First of all, I can acknowledge that we have not been growing as fast as we used to. We used to grow faster than most states, and now we're kind of on average with the rest of the United States. And of course, we're substantially slower than Texas right now. And yes, our labor markets have softened up more. We have a little bit more of an increase in the unemployment rate. Our job openings rate has dropped more so than the nation overall. But with that said, that's growth on what we call the extensive margin. That is to say, how many more people are you hiring? I like to also talk about growth on the intensive margin. As opposed to focusing on how many people are here, how about we focus on how well people are doing? Well, on that front, things look really good. For example, GDP growth in the state's been growing faster than the US over the course of the last 5-6 years. Our personal income growth has been faster than the nation. Back in 2015, your average Californian earned about 10% more than people in the rest of the United States. Right now, that gap's about 18% and rising. So our incomes in the state are rising faster than the rest of the nation. You can see it again on the left-hand side there, where median household incomes here in California, they're almost $100,000. For the rest of the nation, they're only about $80,000. And of the 3,200 counties in the United States, no less than 11 California counties are in the top 100 in terms of median household income. In other words, California pretty much still is the toniest zip code in the nation, as the case may be, whatever the growth metrics may tell you. Poverty rates near an all-time low level. Some good news on the equality front, in as much as over the last 5 years, you've seen household incomes for Hispanics and African Americans rising more than everyone else. Again, the income gap isn't closed, but certainly moving in the right direction. But of course, all we hear in the headlines from California is things like, well, California's poverty rate soars to an alarmingly high level. This came from the California Budget and Policy Center. Alarmingly high level, folks. We went from a record low level of 11.5% to a little over 12%, which is lower than at any point in time, 2019. But of course, our economic think tanks have to call it a soaring to alarmingly high levels. So interesting how we just kind of ignore the reality of things and just pitch our current political predilections no matter what they are. Even in terms of housing, we all understand it is a tough time to be a real estate agent. I just came from the desert, and I was given a talk to city manager, but there was also the California Association of Realtors. They were having their big retreat out there, and I know some of those folks, so I had dinner. It's not a good time to be a real estate broker. I'm just going to tell you that, right? Nothing's going right. And now they're changing the commission system. There's very few sales. Everybody's grappling with overhead. It's ugly. And we know why. Interest rates went from 3% up to 7%, and that shock hit the market, cooled everything off, and everything's kind of in this stasis. But with that said, this isn't 2010. If you think about 2010, you say, what was wrong with the housing market? The answer was there wasn't enough buyers, which is exactly why home prices were plummeting. Today, the problem is there's not enough sellers. Why? Because all these people are locked in on that 30-year fixed rate mortgage at 2.75%. And between you and me, you will pry that 30-year fixed rate mortgage from my cold, dead hand. Just saying, right? So a lot of people are not selling, they're sticking put. And so the ultimate issue here, there's not enough to buy, and that's what's driving prices up. Home prices are rising. U.S., they just hit a record high level of about 415,000, about 5% year over year, despite interest rates not coming down. And that's true in California, where median home prices are approaching $900,000. Here in Orange County, they're up to about 1.4 million. In San Jose, by the way, that looks cheap. The median price of a house in San Jose right now is $1.9 million. And let me explain what you get in San Jose for $1.9 million. You're getting 1/8 of an acre, a 2,100 square foot slab ranch with a small 2-car garage, okay? You're not getting a lot, but that's what the prices are. And yes, they're going up across the board. Take San Jose, they're actually up 10% over the course of the last year, up 49% from where they were back in February 2020. And of course, the issue here, like other places, there's just nothing to buy. Inventories are way down, and that constraint, of course, is what's supporting prices, even though we have this unaffordability problem. Commercial real estate, for all the news over the course of the last couple of years, here's the reality of things. Office, which everybody's been panicked about, seems to be stabilizing. And I know the Bay Area is still grappling with their excess supply of office. But believe it or not, vacancy rates in office are starting to fall. And in the Inland Empire, they're falling in Phoenix. It's just in the big commodity markets that are struggling right now with the excess supply. On the other side of it, of course, industrial, which has been the sweetheart of the overall commercial world, well, things have returned to something resembling normalcy. Vacancy rates are coming up a little bit at that particular time. And yet again, out in the Inland Empire, you're seeing that. So it's a little bit of a mixed bag, as the case may be. What's interesting is there has been an increase in office transactions. What you're starting to see there is workouts. There's no doubt that office prices fell. A lot of lenders basically started owning a building. Maybe the equity holders hadn't acknowledged it yet, but the lenders owned the building. And now they're starting to go through the process of repricing, and that's fine. The good news here is that's occurring without much in the way of what I call overall economic problems. If you look at commercial bank delinquencies, they're basically still near rock bottom, whether you're talking about business loans or commercial real estate loans. And the overall New York Fed bond index, which includes some of these like high yield bonds, again, very little problem. Our debt markets are remarkably clean. And that's because while there has been a repricing of commercial real estate, it is occurring within the context of an expanding economy. You can work these things out when the front of the house is busy and you're still making some money. And that's exactly what's happening. Because the economy is healthy, it's not turning into a systemic problem. You're not seeing the major meltdowns the way you saw in the wake of the Great Recession. And banking, after a couple tough years, is finally moving back to normalcy. The big problems in 2022 and 2023 in banking was the fact that the deposit base was falling. I'll come back to that in just a couple of minutes. That, of course, was driven largely by Federal Reserve policy. But Federal Reserve has backed off a bit. Money supply growth is up again. Deposits are starting to grow. Banks no longer have to borrow to go ahead and continue their lending, and that's making it easier to get debt. If you look at credit constraints, you can see that banks across the board have been really reducing the credit constraints on getting mortgage loans and getting commercial real estate loans. It's not super easy. It's still complicated, more complicated than it was a few years ago, but clearly the worst is behind us and the lending market seems to be getting back to normal. And there's been a little bit of an increase in demand to borrow money. Not much, but again, you start to see the lending markets after a couple of years of really being locked down, getting back to something that resembles normalcy. And of course, you can throw in all the other good news. The spurt of inflation has gone away. I told you equity markets have hit all-time high levels. The Federal Reserve cut interest rates by a full 100 bips over the course of last year. They held pat on this last meeting, but they did cut quite a bit last year. I mean, hell, even crypto's up, right? I mean, briefly, Bitcoin got above 100,000. Now it's subsided a bit. It's back to about $96,823. This is as of yesterday, as the case may be. But that's still near the highest it's ever been. Now, I got to be honest with you. We've done some work in crypto. I have some modeling on this, and I think it's an important thing to be studying. My model does suggest that Bitcoin could be a little overvalued. My model right now suggests it's about $96,823.58 overvalued, give or take a few pennies as the case may be, somewhere in that range. By the way, a lot of my model came out of a wonderful book I read this last summer. It's a wonderful book. It's a biography of an Italian-American gentleman who lived in New York City about 100 years ago. It's an amazing story of rags to riches to jail to deportation of a true American entrepreneur. A wonderful read, I suggest it. Now, with all this said, inflation down, asset prices up, your crypto portfolio looking strong, what's been the national mood? Well, it hasn't reflected any of these things. The mood's been grim. Consumer confidence is still where it was in 2012. Gallup's U.S. satisfaction says we're as unsatisfied as we were back in 2012. More Americans say they are living paycheck to paycheck. 7 in 10 college students say the country is headed off in the wrong track, mainly because they were told they have to go to the office to have a job. You know, it's tragic, right? And in the run-up to this election, this was a standard headline in the Washington Post. The economy's on the line. Which candidate do we trust to save it? Really? Did I show anybody any slides that suggests our economy needs to be saved? But again, narratives versus reality. These are what we hear. This is what people are talking about, but the data is telling us something completely different. You have to acknowledge these are different things. And again, this is how I sort of view the world from a macroeconomic perspective. But for the most part, narratives reflect reality. We mostly agree that the sun rises in the east and sets in the west, and the globe is in fact a globe. It's not flat. So the big things most of us agree on. But over and over, you see very large issues where narratives just don't seem to line up with reality. A place where narratives have triumphed over reality would be, for example, the positive value of Bitcoin. You know, snark aside, I don't believe in cryptocurrency for a very simple reason. Any kid with a master's degree can make another cryptocurrency. How many different cryptocurrencies do we have now? How many more are going to create? How can you possibly have a positive value when there is an infinite number of potential cryptocurrencies? It doesn't make any sense. But to certain people it does. You can go to the websites and watch the videos and read the literature, and for whatever reason in that world, they have created a narrative that has clearly trumped reality. And sure enough, if you want a Bitcoin, you better line up $95,000 because that's what the market says it costs, period. Now, this is not that new. There's another asset that I don't have a lot of faith in, gold. People buy gold. Well, why do you buy gold? Well, it's an inflation hedge. What does that mean? Well, when prices go up, the price of gold goes up. Well, yeah, when inflation goes up, the price of everything goes up. So isn't everything an inflation hedge? Well, it used to be the basis of our currency system. Yeah, like 150 years ago. 150 years ago, we rode horses to work and we beat our kids on a regular basis. It was a different world. We're not going back to a gold-based commodity currency. We're not. But, narratives stick and people invest in gold. And listen, if you invest in gold, don't take any of this as a personal insult. But understand that there is no there. There is no model. What you are doing is you are betting on narratives. And you know, if you're good at that, you can make a lot of money. People do, they have. But for me, I like to see, you know, rent. Just what I like to see, something like that. Now, by the way, on the other side of this, another triumph of narratives over reality, in this case, it's a lack of narrative. Look, I already told you, the federal deficit is clearly unsustainable. We have a big problem, which is exactly why Trump and Harris spent, in that 90 minutes, they had that debate last year, they spent, 3 seconds talking about the deficit in 90 minutes. I'm pretty sure Trump's golf game took more time than the conversations about the deficit. And look, I'm not going to point a finger at Harris and Trump and go, you're out of touch politicians. No, these people have teams of consultants. And these consultants walk into rooms with focus groups and they throw ideas at them. And whatever people think is important, they go back to the candidate and go, well, this is what people care about. Well, if they're not talking about it, it's because their pollsters told them we don't care about it. Well, yet again, that's not a sustainable situation. At some point in time, reality will reign on this parade, and what happens then? That remains to be seen. But it cannot go undiscussed. It just can't, despite our collective state of denial over this particular issue. Now, Schiller wrote a book a couple years ago called Narrative Economics, great book. In it, he says, we need to incorporate the contagion of narratives in economic theory, otherwise remain blind to a very real mechanism for economic change. Absolutely. But Schiller didn't say it first. Keynes called it animal spirits. And my favorite Southern California philosopher, Will Rogers, said it isn't what we don't know that gives us trouble, it's what we know that ain't so. Right? He's talking about false narratives. He's talking about false narratives. Over and over, we see the same pattern. This is the human condition, no doubt about it. Now, how do narratives go so astray? And more importantly, how are narratives so dominant in today's world? Well, you could spend an hour, you could spend a course talking about these topics. If you're interested in this stuff, a couple books I might recommend you to. One is Thinking Fast and Slow. Daniel Kahneman is a psychologist who won the Nobel Prize in Economics for his insanely profound insight into how people think. He points out we have two ways of thinking, type 1, type 2. Type 2, very smart, very logical, takes data, makes the right choice. But he points out our type 2 system is often busy and often lazy. And if type 2 isn't turned on, what is type 1? Type 1 is your old-fashioned thinking. It's an old emotional system. Works very well under defined circumstances. But the thing about type 1 thinking is it's full of cognitive biases. That is to say, we don't see the world in quite the right way. It takes type 2 to be there to filter information and make sure those biases aren't at play, and too often we just are type 1 thinkers. Now, you got to go to the next step, because a wonderful book by Jonathan Haidt called The Righteous Mind, written again about a decade ago, this gets into morality, modern morality. What he talks about is there are some issues that when they come into your world, it's no longer a type 1, type 2 thinking. These are issues that have very specific emotional context attached to them. People talk about fairness, they talk about inequality, they talk about loyalty, they talk about sanctity, and these are emotional issues. When these things come up, it's not as if, well, will type 1 or type 2 be here to discuss this? Type 1 stands up and says, I'm in charge, sit down and shut up, type 2, and you become an emotional thinker. And that's why people get so worked up about certain issues. We become so passionate about politics because these are circumstances where type 1 thinking turns on. And then, of course, you got to throw in that wonderful modern invention of the internet. You know, about 15 years ago, the kings of techdom determined we weren't spending enough time looking at screens. So they unleashed all their AI mechanisms trying to figure out how to get us to spend more time looking at screens. And what they realized is the best way to do that is to kick you in your emotional nodes so that you sit there and stare at your screen. Turns out angry people spend more time looking at their computer than happy people do. So you do have this kind of perfect storm. Here we are, built in this particular way, and you have an internet that's constantly throwing preposterous, over-the-top things at you to try and get you to think in a type 1 way. And lo and behold, the narrative is getting pulled faster and farther away. from the reality of things. It boils down to something very simple. We don't think nearly as much as we think we think. Simple as that. And the best way I can describe this to you, this came out last year, this Federal Reserve survey. They been doing this for a while, where they ask a whole bunch of people, how are you doing financially on a scale to 100? The top line, by the way, is what the average person said. Back in 2017, they said I'm a 74. Today, they say I'm a 72. Now, to be clear, that's the same to me. They're a little better off, but human beings are always a little unsatisfied. The fact that it's drifted down, to me, that's statistically the same. The real interesting thing is those lower two lines, because then they ask these people, well, how do you feel people in your community are doing, and how are people doing in the rest of the country? And those are those lower two lines and the lines that are sloping down. Now, I understand what this implies. It implies that the average person in America thinks they're doing just fine, but the average person in America thinks the average person is doing terrible. That doesn't work right. It doesn't add up. I like to point out, 90% of parents think their kids are above average. It doesn't work that way, okay? I was saying up here, I have two boys at home. I got a 6 and an 8-year-old. Statistically, one's a dumbass. I know that. That's how it works, okay? I think it's the younger one. It's okay. He's very cute. He's very pretty. He's going to land well. He's going to be a great trophy husband. If anybody has a nice daughter in the room, let me know. Anyway, putting that all to one side, you can see the problem here. We all think the world's doing terrible when the world's doing great. And of course, all this chaos started back in the day with the pandemic and the pandemic overreaction. Pandemics don't cause depressions, never have, never will. 100 years ago, the Spanish flu hit the United States, which was vastly worse than COVID, vastly. And yet, didn't cause a depression. What are we talking about? It was nonsensical from the get-go. Doesn't matter. The narrative caught, the narrative took hold. All these quote-unquote economists like Zandi and Nerio Rubini, whose job is to simply feed the narrative, not tell you the truth, stood up and said, all hell is breaking loose, and everybody has to save the world. And there's nothing Congress loves more than saving the world, even if the world doesn't need saving. So, the pandemic, in the end, was the deepest recession in U.S. history. It was the shortest recession in U.S. history. 9% decline in output. It lasted 8 weeks. By the third quarter, the economy is rocketing back. Overall cost the U.S. economy $1.2 trillion. Irrelevant. Despite all the actual data telling us what was going on, Congress deployed $6 trillion of stimulus to quote-unquote fix the economy. That's $5 of stimulus for every single dollar of lost income. That adds up to $50,000 in stimulus for every American household. But you got to remember there's a multiplier effect, because all that money hit the economy. You remember in 2020, 2021, and what happened? Stock prices went up, crypto went up, home prices went up, and that turned around and fed more net worth back to American households. How much more? Well, in the end, between the initial cash injection and the big increase in asset prices, your average American household got a $325,000 in brand new net worth. Well, no wonder the nation's been partying like a rock star. Everybody feels rich, and that's what you do when you feel rich. Simple as that. Now, the other thing, of course, it brought was inflation. Of course it did. Remember, $5 trillion of quantitative easing funded that $6 trillion thing. And remember, $5 trillion of quantitative easing, well, that's $5 trillion of brand new money being poured into the economy, or about a 40% increase in the money supply. Well, a big increase in demand with a big increase in money supply leads to inflation. Of course it does. Of course it does. Truest thing in economics, inflation is caused by too much money chasing after too few goods. And how many times have you heard in the last 3 years, consumers are getting crushed by inflation, consumers' incomes are consumers can't buy anything because of inflation? Stop. Prices are driven by demand. If consumers were being crushed by inflation, inflation would have stopped. When the economy goes into a recession, prices go down. So of course that was nonsensical, but the narrative stuck, and everybody thinks inflation is terrible. 70% of consumers think inflation is outpacing incomes. This was in 2024, when inflation was over, but people still think this. And this, of course, brings me to the election. Oh, wow. Trump's big win clearly motivated the right. The right thinks they have a mandate. The left thinks the end is nigh. Had Harris won, the left would have thought it was a mandate. The right would have told you end is nigh. And here's the reality. There's no mandates in an election anymore. Both parties have gone so far into their own wings that the 2/3 of people in the middle are now non-denominational. They don't assign themselves to either party. And it's the 2/3 in the middle that determine elections, period. And they don't vote on the basis of policies. They vote on the basis of vibes. Look, I went through the last 18 elections, and I made a very simple chart. In fact, it's so simple, I'm mad at myself for not seeing this ahead of time and making a big bet on this election. But once I look, it's obvious. If consumer confidence falls over the course of an administration, you're gone. That happened to Biden because of inflation. By the way, it happened to Trump in his first term because of COVID. Biden didn't cause inflation. Trump didn't cause COVID. But it didn't matter. In both cases, consumer confidence fell. The body in the middle said, you're out, I want something new. That's how it works. So you might say, well, it's just the old expression, it's the economy, stupid, right? No. I just told you the economy's great. It's the narrative. That's what's driving the show. The narrative drove Biden out of office. Rightly or wrongly, that's the situation. And this is where we are. So, by the way, who should Trump thank for his big election win? Well, Jerome Powell, of course, which I find wonderfully ironic since obviously Trump's been going on and on how he wants to get rid of Jerome Powell. Rid of him? Setting aside flowers and candies, maybe a nice trip to Hawaii or something, right? Give him a few of your Trump coins. Be nice to the guy. But again, this is how narratives operate. Now, the real issue in the United States is we don't have enough people. The real issue in our nation is we haven't enough people because we're not having enough babies. Our population pyramid is now a population column. In fact, a few years ago, a bunch of economists got together and said, you want to make the economy grow faster? More immigration. And after Trump's turn, guess what we got? A lot more immigration. And I got to tell you, at some level, we have to appreciate how important that's been for the U.S. economy. Over the last 20 years, we've added 18 million workers. 7 million of those workers were born overseas. You think we don't have enough workers now? Can you imagine where we would be if we didn't have those 7 million people here? Now, be that been or may, there's been a huge surge of people coming in. Part of the reason the economy is growing, part of the reason our farmers are doing great is because of this surge of people. And we know yet again, the narrative about immigration is very clear. Everybody was upset about it. And the one thing I can say about Harris and Trump is they both promised to close the border. Now, I'm not a big fan of undocumented migration, but I'm a big fan of fixing our legal system. And by the way, no one's talking about that particular narrative. So yet again, no complaint about people frustrated about people coming here illegally, but at the same time, we have to admit we need people. It's an interesting place our nation finds itself in. And of course, talking about needing people, talk about California, right? Why aren't we growing as fast as Texas? Well, let me point something out to you. In the last 5 years, our state has added about 600,000 jobs. We've lost 40,000 people from our labor force. Actually, it's kind of a neat trick. It's amazing we've made as many jobs as we had. And if you want about Texas versus California, oh, why are they growing? It's taxes, it's regulations, it's wokeness, it's blah, blah, blah. Nah, forget all that. I can define Texas versus California one thing only, one variable. They build housing, we don't. They're building 20,000 housing permits per month. We can't even build 9,000. Simple as that. Here's the numbers for you. The last 5 years, Texas has seen a 10% increase in their labor force. Ours has shrunk by 0.5%. Honestly, you can't grow an economy without people. It's as simple as that. And that's the nation's problem. It's California's problem. It's not Texas's problem because people are indeed moving there. They're moving to Arizona. And even when you look across California, what are the fastest growing parts of California? Well, number one, Stockton. Yeah, that's Stockton. Out there, yeah, that's Stockton. Number two, Inland Empire, Fresno, Sacramento, Bakersfield, Modesto. It's not till you get to San Diego where you see a major coastal economy on there. But again, time after time after time, it isn't about the health of the economy. It's who has housing, because they have housing, who has a growing labor force. Very simple, not complicated. Now you might say, but that something doesn't add up because population's been going down. People are fleeing the state of California. Now fleeing is a very specific verb. If you say flee, it creates a prediction. My prediction is simple. People fleeing equals higher vacancy rates, right? Flee, vacancy. Here's a problem. We don't have any vacancies. So people clearly are not fleeing because we do not have rising housing vacancies. Housing vacancy rates are the tightest they've ever been, which leads us to another little mystery. How can that be? If population's going down. Well, here's a dirty little secret. While there are fewer people in California, there are more households. Fewer people, more households. And that's happening because there's been a big decline in people per household. Why is there a decline in people per household? Because people are doing so well. I have to point out to people, the 3 worst things any human being can live with: bed bugs, cockroaches, and anyone you're not related to, okay? And even some of the people you might be related to. You do not want to live with them. So as soon as you get a little money, you move out. You move out. And because people are doing so well, they're moving out. And because they're moving out, they're taking the little bit of housing supply and occupying it. And what happens is someone has to get out. And the equilibrium factor is home prices. Because, again, not enough housing, prices are going up. Take a look in LA, for example. Over the last decade, LA has lost 2.5% out of its population, even though it's expanded the number of housing units and the number of households by 8%. How is that happening? People per household has dropped by 10% in a decade. Doesn't sound like a lot. We went from 2.8 to 2.5, but that decline is enough to push people out of state, out of the county, and it, of course, is the fundamental reason we have rising homelessness. It's not because people are doing terrible, but because they're doing well and they're spreading out in a fixed housing supply. So if you don't have the right narrative, you can't fix it. We keep saying we have rising homelessness because housing is too expensive. No, it's too cheap. That's the problem. So if you don't know the right story, you can't get to the right policy, which is why we failed miserably to deal with this. And it isn't just that these changes are causing us not to grow enough, it's torquing our labor markets. Young people are leaving, or we're getting older. We don't have young workers. We don't have unskilled workers. They're in short supply because all of these people with graduate degrees moving here. The one solution to California's problems is more housing, and the one thing we've absolutely, utterly failed to accomplish is build more housing. We still are building the same paltry number of units on a monthly basis, which is a half of what we need. Not to mention trying to make up for what hasn't been built in the last 20 years. It's not complicated. But how can you build housing? Housing is incredibly expensive. You build housing, no one can buy it anyway, right? Gallup did a survey last year. They asked people, is it a good time to buy a house? And never have people thought how bad it was a time to buy a home. This is tragic. It's terrible. You can't buy a house now. No one can afford this. Of course they feel that way. Why? Because every time you pick up a newspaper, there's a newspaper telling you this is the worst time to buy a house ever. Here's the problem. It's not. Look, even with the increase in interest rates, housing affordability coming in 2025 is roughly where we were in 2004 and 5. It isn't that high. By the way, it's better than it was in 1989 and 1990. It isn't that expensive. Now, it's more expensive than a couple of years ago, but the real anomaly here is 2010 to 2019, when home prices were the lowest, most affordable they've ever been because of those rock bottom interest rates. The real question is, why weren't people buying homes over that period of time where homes were record affordable? And the answer was because everybody was running around telling them home prices were too high. Yeah, what an insane world. In 2019, I had people walking up to me saying, so when are home prices going to fall? What? Never. Zandy, remember Zandy? Here we go again. In 2019, Zandy predicted a housing meltdown that will lead to a recession because home prices are too high. What are you talking about? You call yourself an economist? You even look at numbers over there at Moody's? What are you talking about? But of course, That was the story, and people didn't buy. And what's interesting is there is a really interesting story here about how narratives break. They can break slowly, or they can break rapidly. And when you talk about housing, you're talking about a rapidly breaking narrative. Look, in 2019, the housing market was insanely cold. Why? Because everybody was waiting for home prices to fall. Because everybody was waiting for home prices to fall, no one's buying a home, which made the market cold, which meant more people believed that the housing prices were going to fall. And it was this weird little negative equilibrium feedback effect that was keeping the market really, really cold. Then the pandemic hit, and I have this picture in my mind about August of 2020, and there's a family, and they're sitting there like, oh man, interest rates are like 2%. We have tons of money in the bank because we haven't been spending anything. We keep getting checks from this president. You know, screw it. Let's just go buy a house, you know? And they go, okay, and they get their face masks on, and they walk around the corner to the open house, and what do they see? They see a line of 947 people lined up to see the same open house. Do you remember those days? Insane lines. 58 offers come in. It goes out 25%. And immediately the narrative switches from home prices are going to fall to, oh my God, I will never buy a home. Prices jumped 60% in 2 years in the United States. 60%. That narrative snapped, and you've never seen anything like it in your life. Never have we seen home prices go up. And then, of course, Fed steps on the brake, interest rates go up, boom, the party's over. But with that said, prices haven't fallen because of the lack of supply. Because the other thing that happened is not only did people not buy, but builders didn't build. And as a result today, it's not just that there's nobody selling, there's nothing to buy. Vacancy rates for homes, vacancy rates for apartments are at record low levels nationally, and that's the rub. There's nothing out there, so prices are being maintained even at these unaffordable levels. The only little tricky thing here is the fact that there are an increasing inventory of new homes for sale out there, which is odd considering new home sales and permits are pretty strong. But what's going on there is that normal home building process has been interrupted. One of the craziest things, most frustrating things I feel in California is when I hear our state policymakers start talking about how we have a shortage of affordable housing. We don't have enough affordable housing, which is nonsensical because it's the other way around. We don't have enough housing, hence it's not affordable. That's different. Well, we shouldn't build that. Why? Because that's not affordable housing. Builders don't build affordable housing. Builders build nice housing. And that's okay, because in economics we talk about filtering. What does that mean? You build a nice new house, and a nice rich family moves there, and they empty out a house, and an upper middle class family moves into their house, and then a middle class family moves into their house, and then a lower middle class family moves out of the apartment, and they buy their house as the entry level house. We call that filtering. You build at the top to feed at the bottom. If you don't buy that, the opposite of filtering is gentrification. If you don't build at the top, the high income people move into the bottom, drive prices up, and take it away from lower income families. If you believe in gentrification, then you believe in the filtering process. Okay? Now the problem here is that filtering process has been interrupted because that person in the middle is not moving because they have a 30-year fixed rate mortgage at 2.75%. So there is very little movement in the market. And so builders, if they build the right thing in the right place, will make a mint. If you build the wrong thing or in the wrong place, it's just going to sit there. So it becomes a game of being very strategic in how you go about doing this. And candidly, you need to build a lot more entry-level housing and townhouses and condos. This is the way to go. And, of course, apartments as well. Now, apartments is another big sticking point here. Now, apartments are fine in California. Rents are flat. While vacancy rates for apartments are going up in the U.S., they continue to be about 4% here in California. It's interesting. Renter incomes are rising faster than homeowner incomes in Southern California. Rent-to-income ratios are steady, however. How come renter income ratios are steady? Well, mainly because renters are spreading out just like homeowners are. There are declines in people per rental. Why are people per rental household going down? Because they're doing great. But that's not the story, right? Let me go to the next step. Share of renters late on rent, never been lower. And yes, we have a high rent-to-income ratio, but rent-to-income ratios are a useless statistic. I like to think of post-rent income. This is what I like to point out. In LA County, the median rent-to-income is 35%. In the US, it's 32%. However, in Los Angeles, once you pay your rent, you have $42,000 left over. In the rest of the United States, after you pay your lower rent, you only have $35,000 left over. So even if you pay more of your income to rent, it's still better off living in California, which is why people still want to live here. But that's not the story. The story is we have rising homelessness because rents are so high. And of course, now the city and many cities are trying to increase rent control. And even that, we're doing some studies on this. It's just unbelievable how city councils think. Well, why do we need more rent control? Because rent-to-income ratios are going up for RSO tenants. RSO tenant rents are going up not because existing landlords are raising rents on existing tenants. It's because every time a unit becomes vacant, it shoots up in price. They reset the price to something higher, matching the market. Increasing rent control will only increase the rental reset when it does go vacant, making the problem worse, not better. So yet again, false narrative leading to the wrong policy, leading us down some dangerous pathways. And as for the fires, I live over in West LA. I watched the fires. I was in one of the warning zones. I have friends who lost homes. It was tragic. But let's be clear, 11,000 homes out of a population of 9.8 million, out of a total population base, including Orange County and the Fire, of 18 million people. Contrast that to, say, Sonoma. Sonoma, back in 2017, lost 5,000 houses in October 2017 in a population base of 600,000. They were fine. We'll be fine. But with that being said, there's still a lot to learn from this. First thing to learn about is, why are insurance rates going up? Well, because it's riskier to insure homes, all right? It costs more to rebuild, and there's more bad things that happen. It's not just in California, it's Texas and Florida too. Second thing to think about is, what does local government need to be thinking about doing? Well, reducing risks. And they're too busy, of course, chasing various sorts of local social justice issues that they've forgotten the basics of social protection. And that's something we all need to be thinking about, as the case may be. And of course, what's interesting here is, because this has become such a hot potato, the governor has gotten involved. He's shut down the Coastal Commission. He's shutting down CEQA. You know what would be nice? Look, my heart bleeds for these folks, but LA is going to be fine. Southern California is going to be fine. What we really need to walk away from this is, I'm hoping the lesson we learn is, when he backs off and we rebuild rapidly, that what's good for the goose is good for the gander. Wouldn't it be nice if we did this for, well, next few years and allow us to catch up just a little bit? Now, with all that said, there's one thing about us not building enough, which is kind of nice. And also one thing about being in heavily socialized California. If you can't afford your fire insurance, you can go on the state pool. Well, they don't have state pools in Texas and Florida. You can't get hurricane insurance. By the way, we have Prop 13, so if your home went up 50% in value, your taxes didn't. In Texas and Florida, they have Prop 13. Their home prices went up by 60%, and their taxes did too. So in other words, what's interesting here is, in Texas and Florida, there's been a huge increase in existing homes for sale. Not because mortgage rates have gone up, but because the cost of insurance and the cost of taxes have gone up, problems that California isn't actually facing right now. And as much as people like to disparage California, not too long ago I was in Sacramento. I was supposed to see a talk from our insurance commissioner, but he couldn't make the meeting because the insurance commissioner from Texas and Florida was in Sacramento trying to learn how we're doing our state pool, because they need to do it before they have a complete disaster on their hands. So once in a while, believe it or not, I know it's shocking, but once in a while California does indeed get it right. Just saying, just saying. Last but not least, let's end up with the Fed before we wrap it up. I'm sorry if I'm taking a little too long, but I'll go real quick here. The Fed has completely, utterly gaslit the nation. We had nothing to do with inflation. Of course they did, but I also understand why they're gaslighting everybody. Look, if they acknowledged they were the source of inflation, Congress would be baying for their independence. They want to roll them back under the Treasury Department. They don't want that, and so they're going to lie to the American public. Lie. Fine, let them lie. I don't want them under the Treasury Department there. With that said, we get to the end of this year, and the Fed finally starts to cut rates. It didn't this time around. But you got to be really careful, because everybody's all excited. They're cutting rates, but then something didn't happen. Interest rates didn't fall. And that's because you have to read the fine print. Look, the Federal Reserve did two things when it came to fighting inflation. The first thing was raising the federal funds rate, and the second thing they did was quantitative tightening. Quantitative tightening is the opposite of quantitative easing. They sell assets off their books, and they take the money, and they flush it. Here's the key. They started cutting the federal funds rate. They continued quantitative tightening. They continued to reduce the money supply. They have continued to keep bank deposit growth weak. Why? Because this was never about stimulating an economy that doesn't need stimulating. They're just trying to unwind the yield curve. They're trying to unwind the yield curve. That's where they've gotten to, and that's where I think they're going to pretty much stand pat. The argument, you get the federal funds rate to pull the lower end of the curve down, to keep quantitative tightening, to keep the top end of the curve up. That is what they're aiming for, no less, no more, which is exactly why interest rates have not fallen and why the commercial industry is slowly but surely moving away from this weird fantasy that interest rates are going to drop to higher longer. But with that said, it's not higher longer. It's high until it gets higher. Let me explain. As I noted, the real problems in the U.S. is why are balance sheets looking so good? One of those things is the massive federal deficit, 7% of GDP plus 120% then to GDP, and of course the stock market bubble, PE ratios, second highest level. Housing prices, clearly excessively high, only kept that high because, of course, of the fact that builders can't build fast enough. And by the way, if 95,000 is a little rich for you on Bitcoin, a little rich for you, may I suggest you find a slightly more affordable cryptocurrency? May I suggest Fartcoin? No, Fartcoin. I'm not being sophomoric. Look it up. There is an actively traded cryptocurrency called Fartcoin, okay? And before you laugh it off, it has a market capitalization of $1 billion. You working with me here? Something's not quite right, all right? Look, Warren Buffett famously said, be greedy when others are fearful, be fearful when others are greedy. The world's getting greedy. Everybody in this room needs to start getting a little bit fearful. How does it unwind? Well, understand, the federal government is borrowing. Who's lending? It's not us. It's not us, right? Our spending is up. Our savings rates are not up. Who is lending? The answer is the rest of the world. Now, it's not quite that they're buying treasuries. What they are doing, foreigners are coming to the U.S. and they're buying crypto. They're buying the stock market. They're buying homes. They're buying into our hot economy and rising asset prices. And that money gets moved around and eventually gets torqued to buying bonds from the federal government. However you look at it, no matter what the transmission is, we are reliant on the rest of the world for the money we need to continue our excess consumption. And that money, in turn, is reliant on these asset prices continuing to go up. What happens when they stop going up? Well, then the rest of the world becomes less interested in investing here, the dollar starts to fall, and then, of course, interest rates have another big shot up. So the answer here is very clear. Interest rates are going to stay where they are until they start going up again. And the little bit of relief you've seen in the credit markets will quickly start to reverse itself when this happens. The critical issue is, when is this going to happen? And on that one, the answer is, I have no idea. And because the reason I have no idea is very simple. It's not an economic conversation, it's a narrative conversation. Bubbles are driven by narratives, and bubbles are ended by narratives. And understanding shifts in narratives is beyond our data sets. It's beyond our mathematical understanding. The best I can tell you is make the best of the next couple of years, but start battening down the hatches, because at some point out there, there's a big pothole in the road, and it's going to get ugly. So, wrap it up real quick. We could do a couple questions and answers after this. Are we out of the woods? We were never in the woods. The economy's been fine since we came out of the pandemic, and will continue to be fine on the basis of consumer spending. Headwinds are going to intensify. The two most critical numbers you want to pay attention to is the US dollar and the 10-year bond rate. Watch those two, because they're going to be the first places where you really start to see the US economy moving into danger zones. By the way, it could get worse before it gets better. If you start to see household savings rates decline, watch out. It's going to get ugly. But I don't know yet. There's a lot of things in front of us, but we'll see. California, our problem is not there's anything fundamentally wrong in California. Our problem is our narratives are all messed up. No matter what the issues are, because we can't talk about those issues in the right way, we can't come up with the right policies. The state needs more housing, period. Everything else will just fall in behind that. But of course it can't, because we live in a time where the narratives are running absolutely amok. That is our problem. Narratives are out of control, and it's leaving policy and political chaos in its wake. And that's the thing that should scare you more than anything else. How will we deal with these crises when we hit? Depends on the narrative. We just don't know. Which is weird because, we live in the age of information. Everybody has a smartphone in their pocket. You have infinite access to everything you need to know. But we got to keep something in mind. People don't go to the internet for information. There's a wonderful report done by the Pew Charitable Trust where they talked about how new information platforms feed the ancient instinct people have to find information that just syncs with their perspective. The problem is not the information environment. The problem is human nature. It's us. So the way to think about this is we don't live in the age of information. We live in the age of confirmation bias. Because no matter what silliness you believe, somebody out there will believe it with you, and thus confirming your opinions. Now, whether those opinions have to do with the fact that the earth is flat, Australia doesn't exist, or Bitcoin is going to go to the moon and real incomes are falling, they're all different versions of conspiracy theories driven by false narratives ripping through our economy. And the only way we stop this is to look inside ourselves and realize that we are the source of those issues. We are the humans with that human nature and those tendencies that allow us to get pulled down some pretty scary rabbit holes. So, remember, it is easier to fool people than convince them they have been fooled. This is where the nation is right now. Thank you very much. Time for a couple questions? Yeah. Just a couple. I went a little over my allotted time, and I know we got other speakers with really good things to say. So, questions real quick.
Where do you expect the 10-year bond to go on? You mentioned
Yeah.
what is it?
Oh, I can see the 10-year bond getting into the 7% range when this hits. Like, I expect it to stay between 4 and 5% for this year, probably drifting into next year. But then it's going to start going up. And when the dollar starts to decline, it's going to go up a lot. At that point in time, the pressures of the federal government to do something about the deficit will intensify dramatically. And then what are they going to do? Will they be the adults in the room, raise taxes and cut spending? Will they simply hit they just run it out until the bond markets freak out and we have a massive debt crisis? Will the Federal Reserve bail them out of their problems with a couple more rounds of quantitative easing? I don't know. What are the narratives? What are the politics when we get to that point in time? The best I can tell you is be prepared for a bumpy road. But again, when? Hard to say. Yes, sir.
How can you explain, or what's a good measure, why our construction rates, residential, right, that we're hearing right now, nonsensical, like 400, 500, 550, and we're not talking about Bel Air real estate.
You're talking about square foot, per square foot.
Per square foot.
Yeah, sure. Yeah.
How does that compare to Georgia, for instance, right?
But even in Georgia, you're talking $300-400 a square foot, right? Look.
Yes, that's well. No, in Georgia it's 200 max.
No, it's not.
I have direct experience.
Well, I'd like to see those numbers recently.
But let's say plus minus. Let's say.
Well, plus minus. But here, California is expensive to build for the same reason expensive to build everywhere, right? That is to say, the cost of materials has gone up a lot, more so than consumer goods. That is clearly part of the issue there, right? There's no doubt about it. Labor costs have gone up a lot. Remember, I told you, earnings for the bottom 50% have gone up more than the top 50%, and that's mostly construction workers. But yeah, here in California, what else you got to add in? You got to add in all the crazy permit fees you got to pay. You got to add in the fact that some places have to use prevailing labor, and you have lots of code issues. So there's reasons why we're more expensive than other places, but most of that's baked in. Keep something in mind, and that is that insurance costs are going up just as much in Florida and Texas as they are here. So it really, most of it is fundamental. It's just a core cost of building things that have gone up more so than cost of goods, but people don't see that. They go, wow, my insurance is going up faster than the price of a car. That's because it's cheaper to build a car now than it is to build a house. And that's something we all just have to acknowledge. One more? Going once? Oh, yes, really?
You mentioned the labor shortage.
Yeah.
Are there any reliable studies, or have you done any on how humanoid robots may solve that problem?
AI. AI is going to solve everything, right? AI to the rescue. Look, I think AI has some real value, but I'm thinking that AI is not going to have this vast economy sweeping, changing value the way they're pitching it, right? It's going to help in pharmaceuticals. It'll probably help in picking strawberries. But honestly, I don't think, as much as Gen Z seems to think that virtual girlfriends are a great idea, at some point in time, they're going to realize there's a few downsides to that, okay? So, yet again, you've got to be really conscious of these people who are out there selling you everything is great and everything's going to change overnight, and you can't let yourself get swept up in that. And here's the thing that scares me more than anything else about AI. Remember the thing about AI? The thing about AI is very simple. You could build the engine to learn, but then you have to teach it. And how are they teaching it? On the internet. Well, there's your problem, folks. All by itself, that should scare everybody in this room away from AI. So, thank you very much. I appreciate your time and attention today. Hopefully you got the QR code. And
Awesome. Thank you, sir. Certainly passionate about the economy. And I think that the AI has some great charts on here for the cryptocurrency that you can stick in there. That was excellent. So I think we can all agree that Chris is certainly passionate about the economy and is a great speaker. And give him a big hand. I appreciate it.